You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koós, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Happy Friday, everybody. The market is in a long-term uptrend, but short-term, it's just kind of going nowhere right now. In the short term, we're not in an uptrend, we're not in a downtrend either, so I guess you could just call it trendless, and there is such a thing as the market being trendless, not up or down. This is all while we're seeing a lot of coronavirus cases, hospitalizations, and deaths increasing here in the U.S., and there's also a lot of other positives and negatives that I'm going to share today and discuss. But first, as always, as I get everything set up here, a few housekeeping items. First of all, if this is your first time joining us, thank you so much for joining. The Cash Podcast is produced weekly, and Cash stands for, as stated in the intro, Cash stands for creating affluence, success, and happiness. And our mission is for you to learn a little bit more on every single episode so that you become more successful, happier, wealthier, and educated than you were before you started listening today or watching. So come back often and feel free to subscribe. I mentioned listen or watching because we are on iTunes and YouTube. In addition, you can also follow me on Twitter at Adam Koós. You can also follow me on Instagram at Financial Surgeon. And then for today's episode specifically, and last but not least, all links, visuals, charts, tables will be available on our website for those of you that are listening on iTunes today if you want to go back and refer to the charts. And that's at libertaswealth.com under the education section under podcasts. So let's go ahead and get started. Today, like I said, we're talking about coronavirus versus the stock market. I've been saying that the long-term trend is up, and it has been for a few months now. But when you consider, in our market commentary that I wrote this morning and sent out to our clients, I talked about how if you consider the long-term trend a war, the stock market has been winning that war, which consists of a bunch of little battles. Now, we have some more battles that the market's going to come up against over the course of the next, I'd say 10 to 11 weeks especially, and we're going to talk about those today. But pretty much the theme of today's episode is whether or not this uptick in hospitalizations, cases, and deaths with coronavirus is going to stifle the bull market. For those of you that don't know what a bull market is, it's pretty easy to remember once you understand this story. Bull markets and bear markets got their names because bulls attack with their horns from the bottom up, and bears attack with their claws from the top down. So bull markets are up markets, those are good markets, and bear markets are bad markets, obviously, because bears attack with their claws from the top down, which would mean a down market. So I always like to start every episode with a quote, and today's quote, I was thinking a lot about it last night. This morning, as I was performing my analysis across a few time frames on the market, and something that my friend Brian Shannon always likes to say is the stock market is either innocent until proven guilty, or it's guilty until proven innocent. So really probably the number one thing we always need to figure out first before performing any other analysis is whether or not the market is innocent right now or if it's guilty right now. And we're going to talk about that a little bit later. Is the market innocent or is it guilty? So let's move on and look at the first chart that I'd like to show you today. The first chart is the solid black line is the stock market for those of you that are watching on YouTube. The dotted line is a 21-day moving average, and 21 trading days is 1 month. So it's basically a 1 month trend of the market where if you can picture in your mind, for those of you listening on iTunes, whenever the market goes up or down in any given day, that's obviously just one day. Tomorrow's a second day, a third day. We can smooth out those trends by simply adding what's called moving averages or trend lines. I don't like to call them trend lines, but we can call them trend lines just to make it simpler. And what the dotted line that you're looking at in the middle here, for those of you watching on YouTube, is a 21-day moving average, a 21-day trend of the market. So it kind of smooths things out a little bit. And then what I've done here is I've put two bands on the upper and lower side of the chart. The upper band is 3% above the 21-day moving average, and the lower band is 3% below the 21-day moving average. And I've used this for a long time as a short-term look at the market when it gets maybe a little bit overheated, which isn't always a bad thing, by the way. But if you look back to, say, April, May, and June, the market spent a bunch of time above that upper 3% band and stayed that way for quite a while. Now, there was a couple times where it reverted back to the mean, but that's the whole point here, is that typically when the market jumps about, say beyond 3% above that 21-day moving average, it has a tendency to pull back and kind of cool off a little bit. So for instance, if you look in June the market bounced pretty high and got pretty overextended, long in the tooth, whatever you want to call it, and then it pulled back to that 21-day moving average and just kind of consolidated sideways before finding a new leg higher. What we're seeing in the market today, if you can picture, again on iTunes, if you can picture this, basically three lines, and almost like your kind of looks like the old stoplight papers we used to use. I'm dating myself here, but back when I was in kindergarten and first grade, we'd have these stoplight papers where there'd be a line on the top at the red line, a line on the bottom at the green line, and then a dotted yellow line where we'd have to write within the lines for lowercase and uppercase letters, because that's kind of what this looks like here. But whenever the market gets above that upper band, it has a tendency to kind of revert back to the mean or find its way back inside that plus/minus 3% band. And what we've been seeing lately here in the market over the last, call it 3 months really, since September 3rd, is pretty much a digestion sideways. It bounces above that line and then heads back below the bottom line, then back above the top line, back below the bottom line. Whereas normally in a nice, healthy uptrend, you tend to see it bouncing above that top line and then coming back somewhere in the middle, but it doesn't typically, the market doesn't typically get back below the red line, below the bottom line, if we're in a healthy bull market, which again just lends itself to the fact that I think right now what we're looking at is we're looking at a stock market that's pretty much trendless in the short term and is just going sideways, and it's digesting and consolidating after a nice leg up, especially most recently from June through September, we'll call it. So with the election behind us, and obviously plenty of news ahead, of course, with the coronavirus stimulus, the presidency, which we'll talk about a little bit later here. What I'm looking at right now in this chart that I found extremely interesting was that the lower band, and I'm looking at the SPY, by the way, so this is the S&P 500 ETF, so the prices I'm quoting are that. Not the S&P 500, but so the SPY, the lower band yesterday at yesterday's market close, which is Thursday, was sitting right around 340. And what I found really interesting about that is when I take us to our next chart, this is what I'm looking at on my screen here is a 50-day moving average in blue, the blue line with the blue shaded area. I like to say whenever the market is below or in this blue area that's underwater, obviously we don't want to be underwater, and we definitely don't want to be underwater for a very long time because we can only hold our breath for so long. So there's your analogy. So can we get underwater? Yeah, we can. Does it warrant extreme caution? Yes, absolutely. And again, in an analogy, we can't spend too much time below water. If we do, we run out of air. We'll suffocate, and our portfolio will suffocate as well. So what I found really interesting is the lower band on the, I'll go back to the previous chart, the lower band on these 3% bands outside the 21-day moving average, sitting around 340, almost corresponds exactly, within $1 to the 50-day moving average, or again, the 50-day trend line of the stock market, which is sitting at 341. So to me, what that tells me is that that's a pretty significant line in the sand below, which I don't think that we want to get below. Now, there's other levels that I think we need to be paying attention to, one being around the 325 area on the S&P 500 ETF at the SPY, which represents the June highs, the lows at the early part of fall, late part of summer, as well as the lows in September and the lows just before the election. So that's this line in the sand, which would be the worst case scenario that I would not want to get below here. And if so, I would think that the stock market might be losing these battles, and thus we could start to see the tide change in terms of whether or not the stock market is winning the war against the coronavirus and the coronavirus economy. Now, on the top side, the highs that we saw in September, the highs that we saw in October, right now, what we saw this past week is the market go above these levels and then pull back last week, actually. So it kind of a failed breakout, and then it kind of consolidated sideways for a few days, and the market headed back above that ceiling of resistance or potential ceiling of resistance. And then since then, it's just kind of been going sideways again. So kind of if we looked at things from a ultra short-term standpoint, I think what we'd be seeing here is, again, more of a trendless environment where the buyers and the sellers are battling it out right now, and we're trying to see, okay, are we going to have more buying pressure than selling pressure, which would obviously send prices higher from here, or are we going to have more selling pressure than buying pressure, which would obviously send prices lower from here? Now, if for those of us who care about the why, well, I mean, it comes down to a few things that we're going to talk about in a second here. But right now, what I'm looking at is the potential for a bull trap, which is when the market breaks out of a range and then gets thrown back below that range again or into the range. And and it's not a horrible thing quite yet. There's a saying that failed moves in one direction turn out to be fast moves in the opposite direction, and that's what we don't want to see happen here. Is we don't want to see this thing, the market start screaming downward in parabolic fashion like we did during the Corona crash. Now, just to be clear, I don't see that happening. I don't think we're going to see a really, really fast, dramatic drop in the market right now, but I do think that there are some battles that the stock market needs to win over the course of the next 10, 11 weeks in order for it to continue winning the long-term war, keeping it in a long-term uptrend. So best case scenario, we stay above the September highs or get back above the September highs and we head higher. Next best would be to stay above the 50-day moving average, which also represents the lower band or the 3% below the 21-day moving average, like I was just mentioning a second ago in a previous slide. And then the worst case scenario would be to hold above these the highs from June as well as the lows from September and just before the election. So those are the risk levels that I'm watching and that I'm paying attention to in our tactical models when it comes to how invested we are, whether that's 100% or 0% for that matter, or somewhere in between. So moving on, kind of more fundamental here, and I don't think I'm showing you anything that you don't already know, but this is a chart of the U.S. coronavirus cases currently hospitalized, and this is as of yesterday. Yesterday, I'm recording this in the morning. Actually, I guess it's the afternoon already. So I'm recording this in the afternoon of Friday, November 20th, and this is as of yesterday, November 19th, Thursday. And what we're seeing here is that the number of hospitalizations for the coronavirus have gone up dramatically above both the highs from when the virus first came out, as well as the summer highs when we saw that resurgence. And it's pretty early yet. I mean, we're just starting flu season, which doesn't peak for another couple months here. So I think that a lot of these lockdowns and curfews, while nobody likes them, me included, I'm hoping that they work, because this isn't, obviously it's not good for the economy, it's not good for individuals who work for companies or the business owners who employ them. So this is one of the issues here, and I guess now would be a good time to again switch fundamental and go talk about the positives. What's good? Let's talk about the good and the bad in the market right now. The positives are when you look at the market trend. So when I observe the trend of the market right now, long term we're up. So in other words, the long-term trend of the market, in my opinion, is unequivocally up. The intermediate term, which would be, say, call it the 6 month or so 6 to 12 month trend, is also up. And then the short-term trend, I would say that that's flat, like I was mentioning earlier. I think that we're kind of trendless right now, and the market's trying to decide which direction we're going to go from here. Is the next leg going to be up, or is the next leg going to be down? The next positive is that the Federal Reserve has already gone on record saying that it's ready to accommodate should the worst happen. So if things get really bad, it would not be out of the question to see the Federal Reserve and Jerome Powell jump in very quickly and start adding liquidity to the market in order to put, call it a crutch or a kickstand underneath this thing. And then third, and this is important as well, I used to write about this a whole lot more than I do these days, but Yale Hirsch, the Stock Traders Almanac, easier for me to say, has what they call the seasonally good months of the year and the seasonally bad months of the year. The seasonally worst months of the year are between May 1st and Halloween. Obviously, that's over and behind us, and now we're into the seasonally best 6 months of the year, which starts November 1st and ends on April 30th. So from a statistical or historical perspective, we're also sitting in the best months of the year for the stock market. So we've got that wind at our back, supposedly. Now let's talk about some of the concerns that I have, and there's three major concerns. The first concern, and by the way, we're going to go from lowest possibility or lowest probability to highest probability. And the first and lowest probability concern is the possibility of a contested election. The lawsuits that were going on in Michigan were just dropped yesterday. Philadelphia, I believe that's still going on. There's a lot still going on in Georgia with the recount, with the presidential election and the Senate as well. So while I think it's a low possibility and a low probability that the election were to be contested and there were to be a flip in terms of who's going to be the next U.S. president, it is possible. And if that were to happen, I think it goes without saying that there would probably be a lot of civil unrest, potentially riots and things of that nature, which could obviously bleed into the stock market. The next most probable thing that might happen, again, understanding that the contested election, in my opinion, I think is low probability. I think that the second concern is a very high probability because it's already happening right now, and that is the continued increase of coronavirus cases, hospitalizations, and deaths. And as this continues to happen, as we start seeing more cities, counties, and even states shutting down their economies for a second time, what you have there is you have businesses saying, you know what, we tried last time, we barely made it, and now we're doing it again. We're giving up, we're cutting bait, and we're closing our companies. And there's obviously several companies that didn't make it last time, but for those that did make it after the last shutdown, and even though some of these shutdowns that we're having right now aren't technically economic shutdowns, they're recommendations, that still obviously doesn't help when you consider, say, restaurant owners are already only allowed to operate at 50% capacity with profit margins that are half that. So it's really difficult for any even if we were open, the economy was open right now, it's really difficult for some of these companies to operate at full capacity when they're legally not allowed to, first of all. And then second of all, when you start saying, hey, we recommend you stay at home, don't leave the house, and especially for restaurants, bars, and the ancillary businesses tied to those companies, to say that, you know, you can only order food for takeout or things of that nature. So that's definitely a concern. And it could also bleed into the market. And that's what we've been seeing in the stock market almost every day here, is this battle between vaccine news that comes out and then coronavirus cases going up. So the third... I should mention this too. If you're watching on YouTube, there's a tweet that I sent out that I got from Mark Zinder and the New York Society for CPAs. And the stat goes like this. It says, by year end, U.S. renters will owe at least $7.2 billion with a B in past due rent. And this could grow as high as $70 billion if there is no stimulus deal between now and then. So it's estimated that 12.8 million Americans would owe an average of $5,400 on average in missed back payments on rent. And that's the highest probability, is that I just don't think we're going to have a stimulus package passed. And as much as stimulus is rough on the economy and it adds to our national debt, and none of those things are good, when you have a coronavirus pandemic that's shutting down or forcing government agencies, mayors, governors to shut down or at least recommend people stay home, and you have businesses struggling and those businesses shutting down, furloughing and laying off employees, or as they shut down, they temporarily send people home. These people aren't making money, and they can't afford to pay their rent. And whether they have employment income or not, employment income isn't full income either, especially when you look at certain industries that depend on tips or cash tips to pay for a good chunk of their bills. So I think there was a very high probability that we do not have a stimulus package between now and year end, which could possibly lead to financial instability, volatility in the stock market due to the lame duck session that we're experiencing right now. So I think that that's kind of where we're at. And to finish with where we started today, for me, when I look at the market, at least for now, I've outlined my risk levels. I've shared kind of where caution should be warranted, in my opinion, and what I'm paying attention to. But at least for now, going back to Brian Shannon's quote, the market is, without a doubt for now, innocent until proven guilty, and that's how we're going to treat our retirement portfolios. So that's all we've got for today. Feel free to share this episode with your friends and family. And if you'd like to discuss your personal situation further, please remember that you never have to be a client to ask a question. If you'd like to set up an introduction call or Zoom meeting, just head over to our website to schedule something on our calendar. You can get access to my calendar there as well. As I always say, there are thousands and thousands of podcasts out there, and you chose to give ours a listen today. So thank you so much for tuning in. Again, be sure to subscribe on both iTunes and YouTube. And remember, you can sign up at libertaswealth.com to get these updates as well as other screencasts, videos, and articles that we write and produce delivered directly to your email inbox. Feel free to follow us on Facebook at facebook.com/Libertas Wealth. Again, you can follow me on Twitter at Adam Koos and Instagram at Financial Surgeon. So thank you so much once again for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koos. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.